So let's bring in Dan Wang, China Director at Eurasia Group. Dan, thanks so much for your time today. So a growth target there below 5%, which is the lowest growth target since 1991. So how realistic is this goal and how much room are they giving themselves for economic reforms?
So this growth target is a range between 4.5% to 5%, and that's quite new since 2023. And it's former downgrade from the previous growth trajectory, which is reflecting this new focus on debt resolution. And there's clearly a higher tolerance on the job market weakness. And we had anticipated around 5% growth. So I think now, actually, the government is giving them more room to do structural reform when China-US is having this trade truce.
Dan, another point, China's inflation target set at around 2%. This figure is seen as more of a ceiling than a goal that it's trying to achieve. I mean, is this an acknowledgement of the continued lackluster demand?
The CPI last year only grew by 0.2%, so it was way below the target that year. So the 2% this year is very likely to be missed because the consumer confidence is still low. If you look at the fiscal allocation and the policy direction, it is very much still not focusing on consumption. And I don't think that is really a ceiling. It is just a target that the government deemed to be desirable, but the realistic thing on the ground is that we probably will still have a very much deflationary scene in China.
So Dan, I'm wondering what you think about the initiatives to boost domestic consumption, which as you mentioned, is still weak. There is that consumer goods trade-in program, and then you have things like loan interest subsidies, financing guarantees, risk compensation, and also talk of upgrading services for consumers, developing new areas for consumption growth. Any of this, you think going to help in any way, in any significant way to boost domestic consumption?
The trade-in program last year and the year before were both bigger in scale than the allocation this year, and they were not really boosting the consumption per se. They were shoring up a basic growth in consumer market. And this year, I'm actually a bit surprised that the government is still willing to do the trade-in program, because in the last 2 years, the things that can be traded in, like EVs and smartphones, they were exhausted. No more room really to grow in that direction. So the program in place is actually to provide additional stimulus in the consumer market. One other area that's actually also targeting consumer market is on boosting fertility. We have seen several mentions from Premier Li Qiang on the exact number of children they were helping last year. And there will be more measures targeting family with children and lower the cost of raising children. And the scale of that, by rough calculation, is equivalent to the trade-in program. And I think that will be the new focus, actually, for the consumer market boost.
Interesting as well, Dan, it's the aim to create more than 12 million new urban jobs, but they're also trying to promote AI application when AI is expected to hurt white-collar jobs. So how do you think Beijing will do this?
This is a conundrum. I actually cannot see a good way out because AI is replacing high-quality jobs, and instead there are a lot of the flexible type of jobs, which are the gig workers, that are not covered by Social Security. So the government is willing to tolerate this kind of trade-off because they trust that online economy, digital economy, can provide a lot of the short-term jobs. And these are not necessarily good jobs, but they can provide a necessary stream of income to tie China over. But the ultimate goal is still to use high-quality productive forces to finally boost the productivity and the income. And that's a long-term goal.
Dan, I just want to continue on this train or subject, if you like. This AI Plus initiative, it sounds at this point that state-owned enterprises will again be the anchor adopters, and perhaps you have a handful of hand-picked private companies like High Flyer, that will be driving this. So I'm wondering, what this actually means, as China moves towards advanced manufacturing, high tech, and so on. How, what this means actually in terms of, China's industrial structure? Is it pretty much going to be the same, things driven by state-linked companies driving things, making the investments, and as I guess creating the demand as well?
Because the way that Chinese government is pushing this is ahead of the business cycle. If you leave this whole thing to the market, companies and individuals and the government's departments will not adopt AI at this rate, because it does create a lot of pressure for their local economy and employment. But we can see this intention to massively apply AI in all aspects of the economy. Actually, 2026, we'll see a big step up. The AI application is one of those future industries that China will prioritize during the whole 15th Five-Year Plan. And it is also the first time that Chinese government said in the Five-Year Plan that they want to lead in a number of fields. In the past, China always talked about catching up. It never wanted to lead. And in those leading fields that China had in mind include AI, it's at the center, and then robotics, and then drones, on the 6G generation of the telecommunication device. So these things, China will have an edge over the US. So I think in the back of the Chinese government's head, it's still this long-term competition with the US that's driving the industrial policy.
Yeah, and Dan, you know, this is all happening against the backdrop of renewed tensions in the Middle East. We've got China's record trade surplus last year. That was really key to helping it achieve its growth target. But now, with the situation in the Middle East, how vulnerable are all these plans that they announced today to China hitting its new growth target?
The growth target in 2026 will not be hurt by what's going on in Iran or the Middle East as a whole, because it's by sectors. We can see the impact is quite uneven. For the upstream industries, China actually benefits greatly from this chaos, because China dominates in a number of upstream metal processing, the minerals, the raw materials. And when there's a military built up and a war economy going on, then a lot of those demand will trickle down to China, because that part of the supply chain is not easily available in elsewhere. But the oil security and gas security for China is a long-term problem. In 2-3 years, China might have to replace those sanctioned discounted oil that can be settled by RMB with non-sanctioned higher cost oil that cannot be settled by RMB. And by then, the cost of production will be higher, and it can be trickled down to logistics and a wider range of the economy.
All right, Dan, appreciate your time today. Dan Wang, the China director at the Eurasia Group.